Here are 18 of the most common tax mistakes I see physicians make every year and how to avoid them.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to another episode of the Physician Sense Podcast. I am your co-host, Chad Chubb, with the one, the only, a beautiful start to the new year, wearing a brand new, well, maybe it's new, collared shirt, looking dapper as ever, ready for tax, Tyler the Olson. How are you, my friend?
I'm doing good. It's good to see you. It's a beautiful, cold day here. It's like in the 30s. It's like my sweet spot.
I was thinking of you recently. I know that you're no longer in Michigan, but my oldest son is doing a hockey tournament soon in a few weeks in Ann Arbor in the middle of February. And I could not think of a more pristine, beautiful location to be than sunny Michigan in the middle of February.
Now, right there, smack dab in the middle of the mitten, that's a rough time of year because there's something about the warmth of Lake Michigan, relatively speaking, but in terms of atmospheric impact, the warmth of Lake Michigan creates a lot of cloudiness during that time of year. It is extremely depressing. So I'm glad you're just visiting.
Good thing we'll be in a hockey rink with lots of lighting to keep us going. We're taking the whole family. Our youngest has not seen snow. He's our only child that was born in Florida, so he hasn't seen snow yet. So I am optimistic. I miss a good snowstorm. But I was thinking of you. But today we tackle everyone's favorite topic, especially for physicians: taxes. And based on the success of our last little mini series that we did, which was the 12 Steps to Financial Independence, we're recording this clearly a little bit in advance. But part 3 goes live tomorrow. But part 1 and 2 have done really well. So we're now going to take another fantastic thread that you have completed on taxes. There's 18 points here. So I feel like these do really well because we note something and then we have 2 world-class financial advisors just adding input to them. So I think that's why our first one did well. So we'll keep this thing going here. For the viewers, listeners, this post from Tyler is from November 2nd, 2025. We're currently sitting around 43,000 views, over 200 likes, and as I always say, the ratio says it all, over 500 bookmarks. I have a fun trivia question for you, Tyler. You have created a little bit of spread on your followers on Twitter compared to someone else that's very famous in the physician space. Do you know how many more followers you have than the White Coat Investor as of today?
No.
It's 7,000 more followers. Took a little lead here over the holiday season, my friend.
Well, I mean, to be fair, Jim made the decision to stop posting himself. Like he doesn't do it anymore. I think that if he kept it up, it wouldn't have been that way because he had you can tell when someone's actually there, versus just automated. So yeah, no, I mean there's just not very much engagement on their page. But I think it was just like a business decision. There were some very interesting conversations that were occurring as a result of the active conversation. But alas, my Twitter counterpart has gone elsewhere. So yeah, but anyway, yeah, that's I guess that's not surprising because I'm very active on there still.
Yeah. Oh, and I think it goes to show you your tweets provide a lot of value. We can tell they're coming from you. And I don't want to say in defense of Jim, but we do the same thing. Mm-hmm. Someone on my team creates our tweets per se, and we don't do as much tweeting as we once did. We still put a ton of content out there, but we're not bringing that original content, which is why I think threads like what you did for financial independence and now this one do so well, because we're just not seeing that original content from voices that we know and trust, especially in the physician space. So 3-part miniseries. Today, part 1, we're going to cover 6 of the 18. The official topic is most common tax mistakes we see from physicians. First tweet was this: physicians are some of the highest earners in the country. and some of the biggest overpayers in taxes. Here are 18 of the most common tax mistakes I see physicians make every year and how to avoid them. I agree with all of that. I think that, again, the beauty of having us both be able to dive in here is kind of what does Tyler see? What does Chad see? What's out there? So number one, not planning for multiple income types. W-2 plus 1099 plus bonuses equals messy. Fail to plan quarterly estimates or structure 1099 income right, and the IRS sends you a love letter you'll hate. Review pay stubs and project the year's income early on so you can make steady payments. So simple in the tweet, but yet so many layers to it. Where do we start here, Tyler?
So it's about the lack of collaboration between income sources and the tax withholding habits. If you have multiple, and this is so common for doctors working at universities, they get like $130,000 from the medical school, and then they get $200,000 from the doctor's group, and then they've got some 1099 consulting work, and none of those income sources are working together by default. And so the amount that the medical school withholds is going to be based on the information that you fill out on your W-4 with them. And the same thing with the other, the doctor's group. And there's no withholding at all on 1099 income. And then if the doctor's group pays you a bonus because you were productive, that's fantastic. But the default withholding on bonus pay is 22%, which in most cases, that is going to be lowballing the average tax rate of a typical physician. And that's where there's some confusion. You should see how many times Thomas Kopelman has to defend his argument that that bonus pay is not taxed differently, is not taxed higher than like regular income, W-2 income. But the confusing point is that what people have withheld on bonus pay isn't enough. And so then they end up having to pay more later. And that's where they think they're like, oh no, bonuses, they get taxed at a higher rate than W-2 income. It's not true. It's all taxed at the same rate, but the default withholding that's done through a payroll system being 22% is often not enough. And so then February comes around and you're gathering your tax forms and you send it to your accountant, and your accountant's like, so you're going to owe about $18,000 or, whatever it is. I mean, sometimes it's been a lot higher than that. And a failure to plan is what led us here.
Yeah. From my perspective, I would say it's high income earners, clearly our love language as physicians. They get hurt two ways. One, the W-4 does a horrible job with high income households. Most physicians, they fill out that form. They're marking married, they're marking all their kids, when a lot of them probably should just be marking single with no dependents to crank it up as much as possible. And even that might not be enough. You still might have to add some more in there. And then to your point on the bonus pay is, once again, you're kind of getting shorted here on, depending on what your income is, household income is, but that 22%, that bonus could be a little bit lower than what we're looking for. And then you mix in some 1099 with no withholdings, again, two different income sources. You have to plan for this. Having a proactive accountant, but in defense of accountants, you paying $400, $1,000 per year for a tax return is not going to incorporate good proactive tax planning. So just make sure we understand that.
Totally.
And having a good financial advisor that enjoys taxes, right? Right now, this time of year, it's early 26 when we're recording this. We're pretty much rushing right now to get all these year-end pay stubs for clients to make sure if something is off, we can still make that Q4 payment and try to at least make up for some of that. Because it's knowing the tax bill is one of them. But the other issue, the one thing I hate the most is underpayment penalties. And to this day, I am so shocked by how many physicians join us. They send us a tax return and there's underpayment penalties, and they had no idea what that was. It's not even the tax bill that we're concerned about, because it is, but we're more worried about that, as we call it, tipping the IRS on that underpayment penalty. So having someone, whether that's a trusted professional or yourself, to coordinate all this and maybe set up some time with your accountant, not in the middle of April, outside of their busy times, to kind of walk through this. Usually a few tweaks here or there, assuming that your income stays at least consistent, or at least the streams stay consistent, you can get this pretty dialed in, maybe some tweaks here and there. But, two things. You don't see it as often in the physician space, but you don't want really large refunds. You don't want really large tax bills. both of those are not ideal. I always call it that $1,000 sweet spot, either paying in $1,000 or getting $1,000 refund. Like if you're in that plus or minus 1,000, dialed in. But yes, this one for physicians, I think it's a combination of the multiple streams of income, but also the high income throws on the W-4 doesn't do a good job with it. The bonus withholdings doesn't do a good job with it. So it puts physicians in a tough spot.
One thing I like to do sometimes, if the numbers work, like if the 1099 income is not that high, and we're talking about someone that has multiple sources, so they've got W-2, you can enter a manual withholding amount on your W-4 through your job. And sometimes what we'll do is we'll ascertain what the estimated tax liability on the 1099 income is, and then we'll add that in to the W-4. Because then it's just, especially if the 1099 income is a bit haphazard, it is something that they don't have to pay so much attention to because it's automated through the payroll of their W-2 job. They don't have to make quarterly tax payments because they're keeping up with taxes throughout the year that will ultimately be sufficient for their tax liability. So we've done that before, and that creates a more automated, less managing situation. That's worked out pretty well.
Yeah, I almost, when we have a new client that joins us and we kind of see where their gap is, whether they mark single or married or had dependents, sometimes I won't even mess with that part of it. I'll just actually have them tweak the actual extra withholding number because we can see kind of where it's been at. So now we're like, all right, well, you had a $12,000 tax bill. Ideally, we're going to add an extra $1,000 per month in taxes to kind of cover that. Again, whether this is your advisor or your accountant, but remember, there's also something there called a safe harbor number. So when we talk about that underpayment penalty, the easiest safe harbor number to watch is last year's tax bill. So, again, we're recording this in early 26. So you're about to get ready to do 25 taxes. But if you can do 110% of your tax bill from the previous year, that covers your safe harbor. That means you won't have underpayment penalties. Even if you have a massive tax bill, but you still covered 110% of last year's tax bill, you remove that underpayment penalty, which is what we're trying to avoid. The other number is 90% of the given year's tax bill, but that is a moving target. That one's a little bit harder. I think we've noted this on some of our other episodes as well, but you either have 110% of last year's tax bill or 90% of this year, but you're trying to hit one of those two so that we remove those underpayment penalties.
Mm-hmm. Yeah, that's a good reminder. All right, what's up next?
All right, number 2, staying a sole proprietor when setting up a PC or PLLC and electing the S-Corp would save 5 figures. If you're earning $200,000 plus of 1099 income, you may be overpaying self-employment taxes. But setting up too early can also backfire too. Run the math. Very popular topic in the physician space.
Yeah, I mean, there's no default here. It's an exciting topic that doctors like to talk about how they're an S-Corp now, and so now they're saving taxes. But it is a very, very it's a very situation specific decision. Like Tennessee, there is a surtax. I think it's like 6%, 6 some percent. There's like an excise tax that makes S-Corp strategy almost like pointless. And in fact, you end up paying more in taxes. So Tennessee, that's just one example, but your specific state, how much income you have, how much it's costing you in professional fees to manage the payroll and the tax planning and the tax filing. Because if you pay an account to just run, like if everything runs through Schedule C and it's just a sole proprietorship, the accountant tax filing fee is going to be less than if you file S-Corp election. And I'd say the difference is usually at least a couple $1,000s a year. So the tax savings has to exceed that. And then to me, it has to exceed much more than that, because if it's like, oh, I saved $2,300 in taxes and I paid $2,000 in accountant fees, like I saved $300, and you're like, but like now, how much time was involved in this? So I think that it's very much, I'm not trying to like put down my own idea here, but because there are definitely situations where it makes sense to do this, but you don't want to do it by default either. I think I'm coming from a place where I think that there's a lot of content out there that's like trying to get physicians to just do stuff. And they're like, oh yeah, you got to file S-Corp. You got to do that because otherwise you're stupid. And you're like, well, no, it's like, you need to pay attention to this and apply your specific numbers and liabilities to the situation, and then you can make a good decision.
Yeah. This is one of those ones where I instantly think of like a whole bunch of bad like TikTok videos, Instagram things on like S-Corp this, buy a G-Wagon, write the whole thing off. Like all those types of, call them S-Corp memes. Yeah, I like your number 2, that 250. We asked, I don't know if it was on our podcast or maybe it was even on the Wealth Kill YouTube channel, but we were talking to Stephen Jarvis, who's a fantastic accountant, and I believe our number was like 250. Like around 250, it probably starts to make sense to kick the tires. Again, have a good proactive accountant, because this is not brain surgery. This is something where you can run it this way or the S-Corp way. And you can see my tax saving is X. Okay, well, now I have to add in payroll. I have an extra accounting fee because I got to do a separate tax return. These are all things that are not complicated. You just need to find someone that can help you run those numbers. And that's what we see most often is S-Corp was set up too soon. Or S-Corp was set up on like, hey, just go set up an S-Corp, but there's no payroll in place, or they're not even paying themselves. Or it's like, I'm a radiologist. I'm doing, some teleradiology, and I think a fair salary for me is $10,000. That's probably not. The IRS does not tell us what the number is, but I don't know if that's going to pass the sniff test if they come looking. So there's also a whole other rabbit hole we can go down here. But I think your tweet says it best, right? There's a point where when your income is high enough, you're likely overpaying in taxes because you can get the benefits of the S-Corp. But if you do it too soon, you're also getting hurt with the extra fees that come in with having an S-Corp set up too soon. So, that $200,000, $250,000 range, and even there doesn't mean it's going to be perfect for you. So if you're sitting there and then you go run the numbers and it doesn't work out, you're like, what the heck? Chad and Tyler suck. It depends on a lot of factors. Tyler used the Tennessee example. Even states can have different effects on there. Clearly, the biggest bill you're worried about is usually the federal tax bill by a large margin. Some of the higher tax states still are pretty painful. But number 2, that S-Corp it's vital. It's vital on both sides, but you need to understand, the pros and cons to each side of that.
Oh, and to be more specific about the Tennessee issue I mentioned, so it is a 6.5% excise tax on net earnings from business. So all of a sudden, the FICA tax and the federal income tax bracket that you were trying to avoid, it's now being subjected to this additional 6.5%. And it's like, anyway, it's not an easy answer. You have to dig into the details.
Good point. And I've realized as financial advisors, sometimes we nerd out a little bit too much. Keep in mind, self-employment tax in the United States is 15.3%. So you have 12.4% that goes to Social Security. You have 2.9% that goes to Medicare. And then above certain income thresholds, 200, 250, 125, married filing separately, there's a separate 0.9 Medicare. So they're pretty significant numbers, right? You plug in a $200,000 of income. Now, again, you have to pay yourself a reasonable salary, but these are important numbers and big numbers. So to Tyler's point, that surcharge from Tennessee kind of wipes out half of that number there. And that where the math starts to come into play.
Yeah.
All right. Number 3.
Let's do it.
Right in line with this as well when you set up the business appropriately, even personally. But number 3, missing easy deductions. CME, board fees, licenses, cell phone, internet, travel, all deductible for 1099 work. Most docs just don't track it. This is low-hanging fruit, my friend, and I love this one.
And I want to clarify something. All these examples, they only work with 1099 income. If you are wondering if you can deduct any of these from your W-2 income, the answer is no, you cannot under any circumstances. You used to be able to, but you can't now. As for 1099 work, there are some caveats. So travel, as far as mileage is concerned, that is related to travel in between your employment hub, wherever work is being done, and traveling from there to satellite locations. So commuting from home to the hospital does not count. I have had some come back to me and they say, well, I have a home office. And that is not technically incorrect, because if you're doing work from home, then it would make sense that that is now traveling from the main hub to a satellite location like the hospital. But I would just like to remind everyone that the ideas and justifications that you come up with to be able to create reasons to be like, well, this is deductible, this is an office for my work, it's all well and good, but when you get an audit, you're going to have to prove it. And a lot of people, they don't think they're ever going to get audited. And they're like, oh, statistically, it's unlikely to happen. And that's fine. But if you do get audited, you are not going to be comforted at all by the statistics that you were thinking about before. So just make sure that what you're trying to justify is real. So I think specialty specific, like any sort of, like anybody in radiology that does work from home, like that is an obvious, like, yes, that works. And so you can deduct the mileage if you're going to the hospital too. I don't have any other specific specialties in mind, but if you are actually doing work in a specific space in your home, then yes, you have a home office, and that comes with its own deductions too. Mm-hmm. And travel back and forth from your home office to other locations. You can track your mileage and deduct it. Just don't just like say, well, I can deduct everything, because you can't. Yeah. Anyway, rant over. What are your thoughts?
No, that's good. Yeah. The only thing I was going to add in there, if you are 1099, but your employer does reimburse you, even though it's separate from your 1099 pay. Remember, reimbursed should not be deducted. The other one I always like to note here is if you travel to a conference, that type of travel is also covered. Now, we're not going to make it overly complicated and say that, it was a 2-day conference in Hawaii, but you stayed for 2 weeks. Then we add some layers there. Some of it is deductible, right, for the business reasons. But that's another one that whenever we see that 1099 income, we really get excited. If you're doing anything for your academic institution or your regular employer that's not reimbursing you or not covering you for things that are sometimes covered by some employers. So I think that list covers it well. With all of them, right? It's always based on what percent was for work. I'm just thinking of like when you put in cell phone and internet, those types of things. It's always based on how much was for the actual work side of it. But document. I always say if you had an expense that you think was business related and you had 1099 income, put it in a nice little file somewhere, share it with your accountant. They'll give you their 2 cents. But usually if it was, as Tyler said, if you can justify that it was truly a business expense, it likely will pass the sniff test. But don't miss the easy deductions. That's one that we see that one all too often.
Yeah. One other thing I'm thinking about too is the relationship that you have with your accountant, because I work with a variety of accountants, like in collaboration with our clients, and they have different personalities, and they also have different levels of, how do I say it? Conscience impact. And so you need to recognize the role that your accountant is playing. So when they ask you questions, and I've had some clients tell me this, that they feel like their accountant is advocating for the IRS and they're like quizzing them. Have you heard this before?
In a similar fashion, maybe not identical, but yes, I'm picking up what you're putting down.
And they don't, the client doesn't like it because they're like, well, you're supposed to be advocating for me. You're supposed to be advocating for me, not for the IRS. And there's some, there's some gray areas at times in terms of like how you arrive at a deduction decision in conversation with a tax professional. But if they are telling you that something is not deductible and you think, well, I think that they're just not being aggressive enough, you have to remember that they are putting their reputation on the line when they sign that tax return. because they're saying that they have done their due diligence to ascertain that what you're deducting is deductible and that they've done the best that they could to be able to provide an honest assessment of your tax liability. If you don't like it, then go find another accountant. It doesn't mean that they're not a good accountant. There's just some variation in how accountants approach these sort of conversations. And so you do need to work with someone that you feel is supporting you. But at the same time, do not go find like I've had prospective clients contact us and be like, we're looking for aggressive tax strategies. And I'm like, no, like that right away, I can tell what they're looking for. And I mean, we don't do filing anyway, but they're looking for someone to advocate for some fringe stuff. And you don't want that either. Like, come on. In this realm of stuff, the benefits of really getting into the higher risk areas, audit risk and like what would happen if, how you would not be able to justify things. It's just not worth it to me. But anyway, that whole thing about the accountant relationship, that's come up a few times over the past couple of years. And it's important to understand. I want everyone to be able to understand why accountants ask the questions that they do. They're putting their reputation on the line.
Yeah, well said. I would say there's plenty of legit tax deductions out there. You just don't remember a lot of these things compound. If you make a bad decision and sure, your odds of getting audited are very slim. But if you are, and it's something you messed up and it was larger and years have gone by, these can be some significant issues. So just be aware of that. I'm comfortable saying most accountants are definitely on your side, but they still have to follow the playbook, even if it feels like they might be leaning a little bit towards the IRS side to more or less ideally to protect you.
Yeah, when you think, oh, they're advocating for the IRS, they're not. They're trying to protect you because they're seeing things from the IRS's perspective. Sure, it may be a devil's advocate position, but it's to protect you. So anyway, I could go on and on.
I'm with you. I get it. Preach. All right, number 4, not paying quarterly taxes. Moonlighting or locums income, ? You need to send the IRS checks during the year, not after. Underpayment penalties are brutal and totally avoidable with planning. I already feel like we gave this one a nice appetizer. Number 4, quarterly taxes.
Yeah, I've had this. What prompted this is 3 different doctors came to me and told me that this is the result of inadequate tax planning infrastructure. I've seen it with W-2 employees. I've seen it with partners. The partnership role where you have like a partnership level accountant. It's weird because yes, it can be helpful if there's an accountant that like is familiar with what the practice has been doing for years, and they're even responsible for filling out the Form 1065 and the K-1s, and so they know the innards of everything. And so then you're like, well, I'll have them be my accountant too, because then it just makes sense. Sometimes that works, but sometimes they're not really paying attention to you because they're a corporate accountant and their brains a lot of them, they don't easily make that transition to the personal side for some reason. And so I've had some doctors who have been under the impression that they just need to put their tax savings into a high yield savings account throughout the year and then, get ready to make one lump sum payment like January 15th or April 15th. And man, like once you actually input the dates when you made the payments, the IRS, they know what's happening here. They track payments and they know you can't just log in and be like, oh yeah, like I made these payments earlier throughout the year. You have to put in the date that the payment was made. And then from there, they calculate what will inevitably be penalties and interest. So you got to pace it out. April 15th for January through March income. June 15th for April and May income. September 15th for June through August income. And January 15th for September through December income. You got to get that on your calendar and make those payments at irs.gov/pay and your state, if your state charges state income tax every quarter.
Well said. I was looking because it was 8%. It's back down to 7%. But the underpayment penalty is a 7% interest rate. 7%. It's again, it's not, this little issue. We've seen clients, every now and then, do we see like $100, $200? We literally just reviewed one yesterday for a client. It's $200. I still think that's too much, but I can understand if you're, a little bit off, understandable. It's when we start to see like close to four figures, we've seen, mid four figures. I mean, we've seen some pretty hefty tax bills, underpayment tax bills that are completely avoidable. I mean, these are things that can easily be dialed in, again, with a good proactive accountant, with a good financial advisor. I mean, these are things that should not be happening. And when we talk about quarterly payments, as Tyler noted, it's weighted. So if you know you have to make quarterly payments, you should almost do the exact opposite of, I'll just wait till the very end. You should actually go into that Q1 estimate and load that bad boy up. Like if you're going to make one massive payment, do that on April 15th or do that on your actual tax day, which is, oddly enough, that's your Q1 payment for the upcoming year as well. So if you're going to just throw money at it blindly, you should actually do it as early as possible, because the weighting then will at least distribute it out better throughout the year compared to trying to play catch up on the one coming up, on January 15th. It ends up being a little bit later this year. You're then getting charged that penalty for all the underpayments before that. So whether this is adjustments with your quarterly payments, whether this is what Tyler noted, making updates to your W-4 that kind of help offset some of the 1099 or bonuses, those types of issues, you should not have an underpayment penalty. I forget what the line is. I know it's like line is right after your tax bill, but it says underpayment penalties on there. And if you see a number there, you need to have a conversation with your accountant on why that's occurring. And if you see it year after year after year, you definitely want to have that conversation, or find a financial advisor that loves to nerd out on taxes and work on some type of solution. And even there, good financial advisor will likely want to collaborate with an accountant, because we're not filing your taxes at the end of the day. We don't have to sign off. But quarterly taxes are vital. If you don't like the idea of adding something else to your to-do list in terms of making these quarterly payments, even though you can pretty much do it in 5 steps, follow Tyler's advice there, crank up that W-4 instead, and then you can start to pretty much eliminate the quarterly payments. Do you have a lot of clients that kick back on quarterly? Like, do they dislike quarterly payments because it's an extra to do, or they don't mind it?
Our clients don't mind it. What we do is we have a workflow in our process to remind our 1099 income clients to make those quarterly payments so that they have that added layer of support. Now, sometimes their accountants do that too. And so they don't seem to mind it. Why, do yours?
No, most don't. We have a few that are like, but they still get it done. Yeah. Sometimes they'll schedule them in advance too. I know some accountants will do that too, but a lot of them seem to not like to do that, where they actually get in and set them up for the client.
Yeah. For the most part, they don't seem to mind it. They just want to understand why they're necessary and like what it represents. Yeah. One thing about the April 15th payment, I mean, you should be making a Q1 payment no matter what, but if you do a larger amount, just make sure that when you go to make those payments, that it is separate. Like, some people try to I've seen people make a massive payment for their balance due for 2024 and also then just ratchet that up with their Q1 estimate. You want to make those payments separate, because like on the drop-down menu at the irs.gov pay page, there's different reasons that you're making a payment. And the most common are balance due for the previous tax year, and then there's estimated payment for the current quarter. And you just want to make sure that you select the right one. And if you owe money for last year and you're trying to make an estimated payment for Q1, you're going to have 2 separate payments. And you want to just make sure that there's a demarcation there. It can get challenging if the IRS gets like one lump sum payment. They don't know what to do with that. So you got to make sure to divide it up.
And that reminds me of a fun little tax too. If you're a person that you usually file an extension and you have an overpayment, but you already missed Q1, possibly even missed Q2, you can always apply that overpayment and it gets added to your Q1 estimate. So it's kind of a way to backfill if needed.
Wait, say that again?
So if you are filing an extension and you find out that you overpaid on your taxes, right, you're going to get a refund.
Oh, yeah.
If you apply that refund, and now at this point, Q1 and Q2 is already passed, right? But now your accountant's like, hey, you should be making estimates. you can always apply that and catch up a little bit on Q1. So it's kind of like this way to front load your estimated payments if you had an overpayment and you were already going to pay quarterlies.
Wait, if you file an extension?
If you file an extension and you overpaid.
And so you're supposed to get a refund, but so how have you seen that play out where, because like, let's say you're doing it for PSLF reasons, like student loan stuff, and you wait until October 1 to actually file.
Yeah.
That's when the refund would be applied. You're saying that the accountant applies the refund to the current year tax liability, and that counts as like
a Q1 estimated payment. Yeah.
Since they already have the money.
Correct.
Okay.
That was one that we because we had a new client that joined us. So we essentially came in a little bit late. They got a good size refund, but they were already on track to pay quarterlies. But by the time we started working together, it was already Q3. So the accountant, we asked the question like, hey, where does it get applied to? They confirmed that it would get applied to Q1, which was good because we were already playing catch up. So it was a way for us to kind of put some on the back when we talk about how they weight those. So kind of a neat little
oh, cool.
Call it a trick there.
Yeah. Wow, that's good to know.
That is from a trusted accountant source. So if someone challenges me on that, don't blame me, but I do believe that all checks out. And it makes sense to me as well.
Yeah, no, that makes sense to me too. Yeah.
All right. We were going to go through 6. I think based on time, let's stop at 5 for this one. So we have one more, and then we'll catch up on the next episode here. All right. So number 5, doing the backdoor Roth wrong. If you have a pre-tax IRA balance, your backdoor Roth triggers taxes. Clean up your IRA, or I'm going to add in IRAs, plural, first. My love language, the backdoor Roth. So many ways to mess up this beautiful, beautiful opportunity.
Yeah. So when we say IRAs, we're talking about traditional IRAs, rollover IRAs, SEP IRAs, and simple IRAs. The last one is highly unlikely to be in your, in people's world, but they exist. In any event, if you have money in any of those types of accounts, you cannot do the backdoor Roth effectively. The reason for this is the IRS has a rule called the Pro Rata rule. And what that means is essentially if you do a conversion of money from a traditional IRA to a Roth IRA, they are going to apply the conversion amount and whether or not it is money that was deducted upon contribution or money that was not deducted on a pro rata or ratioed basis. Say this was in 2025, and so the limit on a Roth IRA last year was $7,000. It's $7,500 now. But last year was $7,000. Let's say you had $63,000 in a SEP IRA that had been you had made the deduction when you made the contribution, which is very typical. That's it's for self-employed income. You can make a retirement plan contribution, and a SEP IRA can be useful in some cases, but it is a pre-tax contribution. If you then try to do the backdoor Roth where you open up a traditional IRA, put $7,000 in it, and then you try to convert that $7,000 to the Roth, which is the backdoor Roth process, the IRS is going to apply not the $7,000 non-deductible contribution as like a whole, like this conversion of $7,000 is not taxable. They're going to apply all $70,000 of IRA money. So the $63,000, they're going to count that as the whole of your IRAs, and they are, how much does $7,000 represent of 70,000? 10%. So what will happen is 90% of your contribution will be a taxable conversion, and only 10% will be a tax-free conversion. The whole point of doing the backdoor Roth is to be able to move $7,000 for 2025, $7,500 for 2026, for those of you under 50. Move it into the traditional IRA, convert it to the Roth IRA on a tax-free basis so that you can then invest it on a tax-free growing basis. But you get hobbled if you had SEP IRA money because now that $7,000 contribution is taxable, or most of it is. So you got to make sure that you move assets from the SEP IRA, from the simple IRA, from the traditional IRA, from the rollover IRA, either into your current employer's 401k or 403b plan, or if you're self-employed, open up a solo 401k and get the money up into the solo 401k. Because money in those types of accounts do not have the pro rata rule applied to them. And then once the money's up in there, now you are free to do the backdoor Roth process. Sorry, that was long.
No, that's beautiful though. You actually added numbers to it as well. I think you covered that one beautifully. Yeah. In short, if you think you've been doing the backdoor Roth IRA, but you have the accounts that you mentioned, I always just say IRA, simple IRA, SEP IRA, you have not been doing backdoor Roth IRAs correctly. But for most of you, it's an easy fix. As Tyler noted, get those older IRAs or current IRAs, roll them into your current employer 401k, 403b plan. If you have 1099 income, or if you have an opportunity to add 1099 income, I think I've made this note before. We even have some physicians that'll actually just take a whole bunch of medical surveys, get enough money to actually trigger a 1099, create a small solo K that they can then fund, and boom, we can then start to do backdoor Roth IRAs, and they keep control of those assets. 401ks, 403bs have come a long way in the last decade, where a lot of their fees are much lower now. So that's an easier route. But yes, there are a lot of ways to mess up the backdoor Roth IRA, and pro rata is one of the highest chances that you will mess them up. So if you have those accounts, get them cleaned up.
Amen.
And as we always do, we talked more than anticipated. So we'll go through 5 for this episode. We will come back for the next one here, and we will pick up on number 6. Any closing parts?
It was great to see you.
Making me blush.
That's all I got.
Yeah.
My brain is saturated. We talked about a lot. No, this is a really good conversation. Listen to this again if you need to, just to get it sounded, some of the details sounded down, because it's a lot of detail, but very, very important stuff. It was a great convo, man.
Yeah, I agree. And it should be nice and organized. So if 1099 does not apply to you, skip that number, go to the next one. But we'll pick up next episode at number 6, and we'll keep rolling through. Always a pleasure seeing you, my friend. I'll catch you on the next one.
See you.
See you, Tyler.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Deals Advisory Services and Financial Planning offered through Vicus Capital, Inc., a federally registered investment advisor. Olson Consulting, LLC, offering advisory services and financial planning, is a state-registered investment advisor.